All right, welcome back, guys. Jeremy Johnson here with Journey Home Realty again for part 3 of the May market update for you. We're going to talk about interest rates, and I think this slide opens it up perfectly. This slide, the biggest thing when we're looking at mortgage rates right now is volatility. It is absolutely a volatile market. I think you guys seen that with rates. Kind of all over the rate, all over the place, and touched 8% in October of last year. We're down in the low 7s for 30-year conventional, 6.75 for VA as of this recording. So absolutely, it is a volatile market. So why is it a volatile market? And I want to hit this next slide here and kind of show you what I was talking about since October of last year. When leading into November timeframe when we touched 8s on a 30-year fix to where it's been all the way down to in the 6.6s for the 30-year fixed, kind of climbed back up, and it's done all these little things. So what drives that 7.6 to 8 to 7.2, all this back and forth and making it so volatile? We're going to look at 3 slides of experts on what they're saying about it, and then dig into 2 factors that really drive that on where we're at, and what the feds want to make sure we don't repeat history in a certain area. So this first slide here is by Odetta Cushing, Deputy Chief Economic of First America, and she says every month brings a new set of inflation and labor data that can influence the direction of mortgage rates. Ongoing inflation deceleration, a slowing economy, and even geopolitical uncertainty. We've talked about that in previous months. Anything going on, across the world, geopolitical uncertainties can contribute to lower mortgage rates. On the other hand, data that signals upside risk to inflation may result in higher risks. So if geopolitical things are going on, and labor rates are bottoming out, and inflation is skyrocketing, then rates, the saying is the higher the inflation, typically the higher the mortgage rates. So that's kind of what Odetta is saying there. Next one here is out of Nerdwallet. It says mortgage rates are influenced by many elements, including the inflation rate, the pace of job creation. So we're always looking for that job market report to come out, the inflation, where the inflation's at, and that's really going to kind of give us an idea of where the mortgage rates are going to be, and whether the economy is growing or shrinking. The Federal Reserve monetary policy is a factor too, and is set by the Federal Open Market Committee, so FOMC. We'll see that again in a minute here. And then Forbes, mortgage rates are indirectly influenced by the Federal Reserve, so they're not the sole factor in it, but it is influenced by the Federal Reserve's monetary policy. When the central bank raises the federal funds target, as it did throughout 2022 and 2023, we'll see a chart in a minute, that has a knock-on effect by causing short-term interest rates to go up. The next thing I want to talk about here is the Fed's latest decision, and it was on May 1st. So this report, we're just a hair late on this report here, but May 1st, the latest Fed's decision was to maintain the target range of the federal funds rate at 5.1, 5.25 to 5.5. Not raise it, not lower it, but maintain it. And we're going to look at that in a reason why that was the decision that was made, and what they're trying to prevent. So here's the committee's assessment on this slide after the latest Fed decision. Committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation, pressures and inflation expectations, and financial and international development. So that geopolitical that we were talking about. So here were some of the results of it. The labor data was released as well a couple of days after the Fed's update on the 1st of May. It says the U.S. economy added fewer jobs than expected in April, while the unemployment rate rose, lifting hopes that the Federal Reserve will be able to cut interest rates in the coming months. Non-farm payrolls increased 175,000 on the month, below the $240,000 estimate from the Dow Jones consensus. The unemployment rate ticked higher to 6.9 against expectations that it would be steady at 3.8. So the unemployment went up and we had less jobs. You see this next unemployment slide here has changed a little in April, but you can see it's from 2020, January of 2020 until April of 2024. Obviously, the big red hikes there in 2020 was the pandemic, and unemployment rate was at an all-time high. The average is around 5.7, but we're at 3.9 in April, and they thought it was going to be at 3.8. So unemployment was going up. That is a cooling factor that factors into it. And then there was more jobs added, not as much as expected, but there is more jobs, which is another cooling factor. So the Feds look at multiple cooling factors to determine, do we need to lower the rates a little bit, or do we need to maintain? They've chose to maintain for the most part for a reason. As Daniel Hale says here, today's cooler labor market data is a sign that mortgage rate relief could be on the horizon, but that will be dependent on inflation. We may see an unseasonably active summer and fall in inflation improves and mortgage rates drop. So the next thing I want to talk about is inflation. So inflation, this chart here shows where inflation in June of 2022 was at a 4-year high at 8.9%, and we are inflation's still higher than they want it to be, because the target for inflation is around the 2% area, and we're a tick over 3 as of March. Mike Fontani, Chief Economics Mortgage Bankers Association, explains a little bit here. Says the FOMC, that Federal Open Market Committee, did not change the federal funds target at its May meeting, as incoming data regarding the strength of the economy and stubbornly high inflation have resulted in a shift in the timing of a first rate cut. We expect mortgage rates to drop later this year. I know we said this earlier this year, but it didn't happen because the labor numbers and inflation numbers weren't where they needed to be. And we got to be careful that as soon as we start seeing a downtick in them, that we don't make a drastic cut. Because I'll give you a slide here, as I've been promising, of what was done back in 1970 and what happened. So the next two slides here, Jerome Powell says here, reducing policy restraint too soon or too much could result in a reversal of progress we have seen in inflation and ultimately require even tighter policy to get inflation back to 2%. So yes, we're at 3.9, but the Feds can't move too quick. Otherwise, we'll lower and then we'll come back up, as we'll see in a chart here in a minute. And then we're going to look at the CPI history. This is the chart I've been talking about here, of what the Feds want to make sure that we don't repeat history. And you can see in the 1970s, the inflation rose, they did a cut, and they cut mortgage rates, and the Fed cuts were too low, and it skyrocketed interest rates to an all-time high. I mean, 40, 50-year high there. So the Feds are aware of that and just want to make sure that we don't do that again. So data is starting to feel like we are going to be able to lower a little bit. We want to make sure it's over a consecutive months so we don't come down and then skyrocket back up. So last thing I want to leave you with is the 2024 mortgage rate projections. I shared this with you earlier this year. We were looking at, Feds were expecting, early spring or late spring, early summer reduction in rates. Seen slight ticks, and then it's kind of went back up a little bit because of different labor reports that are coming out and things that we've talked about. Here's the new projections for 2024. Again, like I said, it's extremely volatile, but we want to see trends continue to go where they are in the May, as the May committee said when the report came out. But the expectation now across Fannie Mae, MBA, and NAR is quarter 4 in the September-October timeframe. They believe 30-year fixed rates could be down in the 6.4, 6.43 rate. And then you kind of see quarter 1 of next year and quarter 2 ticking down to that low 6s. I know we did a report and we're talking about getting in the year of the 5s, and we were going to see the high 5s again. And I've said it before, we have to make sure that if you are in a financial position to be able to purchase now, why experts keep saying it's the best time to purchase. I know it goes contrary to what we said in the affordability, but finding the house that fits for you inside your budget and your family's budget, get in now at the 6.4, 6.5, 6.7%, and when the rates start to come down, refinance. We hear a lot of people say, I'm just going to go ahead and wait and stay on the sideline. I'll rent for a year, and renting's not the end of the world. I mean, it's some people need it, but don't do that because you're in fear of what the rates are going to do. We're here to educate you in it. so you can, be educated in the process. If you can get inside of a loan now, and then in a year, a lot of mortgage companies out there, or lenders out there, offering interest rate reduction loans. If after 7 months, 7, 8, 9 months, if it lowers, a lot of lenders are offering discounts, or they'll do your refinance for free for you. So explore those when you're talking with a lender. But if you feel like it's the right time and it fits in your family's budget to buy a house now, it's absolutely the right time, because I'm telling you, we get down in the low 6s and the high 5s again, I believe we'll start seeing, again, not as crazy as the pandemic years and the unicorn years, as we've called it, but we'll see multiple offers again, and it's going to be harder because we are still absolutely in a seller's market, because it's a supply and inventory issue. More people want a house than there are houses. Builders are getting after it, building the smaller homes, as we talked about, for the affordability rate, as we talked about in episode 1. So things are being put into place for it to happen, but don't wait because you believe that the rates are just going to plummet, and then my affordability is going to be a lot better, and I can buy a bigger house. I'm telling you, there's going to be more people in the market. So again, as every month that we do these reports, we just want to make sure that we're providing you fact-based, data-driven, non-emotional information, so you can make a decision based on what works for your family and your budget, so we're not running into a market with fear and watching the news and everything. Reach out to us. We'd love to be able to help you, just kind of educate you on it. We'll educate you before we ever sell you a home, is what we always tell our clients. And there's a lot of good lenders out there and real estate agents out there that are built the same way to get you through it and make sure that you can live the American dream and get into a home that you want. So hope you guys had a great Memorial Day weekend as we lead into the summer months. But we got our middle son graduating in a couple weeks. It's going to be a busy couple months. All the 2024 graduates out there, we congratulate you. And we'll see you again next month. Thanks. God bless.